Okay, let's get started. By now, you are getting sick of this valuation model, so-called dividend growth model. Dividend growth model is simply price is a ratio of expected dividend for next period over R minus G, R being required rate of return or expected rate of return on the stock, or from the company's point of view, it's cost of equity capital. R minus G, growth rate of dividend and earnings. If you change D1, expected dividend, into earnings, then you use a new concept, payout ratio. Payout ratio times earnings per share divided by R minus G. That gives price. And divide both sides by E1, you have a familiar price earnings ratio or price earnings multiple. And price earnings multiple is theta divided by R minus G. And from here, you can easily see that the higher the growth, the higher the price earnings ratio. The higher the discount rate, the lower the price earnings ratio. Since discount rate R is a positive function of risk, the higher the risk, the lower the price earnings ratio. And about theta versus price earnings ratio. And the answer is it depends. It depends upon the sign between ROI and R, return on investment of the firm, and required rate of return of the firm, R. Okay. And as I told you, it can be shown that growth rate is 1 minus theta, that it's retention ratio, that the proportion of earnings that are retained within the firm times return on investment, ROI. Growth in earnings and dividends is determined by how profitable the company's investment opportunities and how much earnings is invested. So-called ROI and retention ratio determine growth rate. The higher you retain, the higher the growth rate, and the higher the return on investment opportunities, the higher the growth rate. It's obvious. It's very intuitive. Replace G with the expression on the right of this equation. You have the following price earnings multiple. Price earnings ratio is nothing but theta divided by R minus retention ratio times ROI. Then you can tell, you can see whether or not price earnings ratio and dividend payout ratio, how they are related. Okay? The question is, should the company pay more as dividends in order to increase price? Or should the company pay less to increase stock price? Which way should the stock price go if you change your dividend policy, theta? And we showed last time that as theta rises, the higher the theta, the higher the payout ratio, the smaller the company retains, price earnings ratio will rise. Price earnings ratio will be higher for the higher the payout ratio if the company's rate of return, company's return on investment opportunities is less than required rate of return by the firm's shareholders. Suppose shareholders are requiring 10% rate of return. Shareholders require 10% because they themselves can obtain 10% return on their investment. Shareholders require 10%. And the company, suppose, has great opportunity to invest, and the company can make 50% return. Should the company invest or not? The company has an investment opportunity that gives 50% return, and shareholders are requiring 10% return. Should the company invest? Right? It should invest. It should invest. The only money it has is amount of earnings it has. Okay. Should it pay them as dividends or should it invest? The only money it has is the amount of earnings it has made for the year. Okay. It has, say, $1 million of earnings. Should it pay them out as dividends or should it invest? Invest. It should invest. So if it wants to invest in a good opportunity, that's this case, return on investment is greater than required rate of return, then the company should retain and invest, reduce theta, so that price-earnings ratio can go up. So if the company has investment opportunities, it's best for the company to retain. If the company does not have investment opportunities, it's best for the companies to pay them out as dividends. And it is generally the case that companies with growth opportunities, like Facebook, Google, Apple Computer, some of these high growth companies, they tend to pay low dividends because they rather reinvest within the firm's growth opportunities. But on the other hand, companies that makes food, clothing, or household goods, many of these, they don't have many growth opportunities. And for those companies, they tend to pay large amount of earnings as dividends. So high dividend firms tend to be the ones that grow less. And low dividend paying firms tend to be high growth firms. High growth, low dividends. Low growth, high dividends. Okay? That's the kind of regularities that we observe in corporate finance. Now, here is one, in a sense, very complicated problem, but comprehensive problem. So I would like to walk with you this problem. Last time I said, forget it, and I'll jump over to the next page. But today, I'm going to go over this problem with you, and I promise that I'm going to write a similar problem in your exam, and I would like you to get 100% of it, okay? Because I am revealing my exam question to you. Okay, you heard it. You heard it. I'm not joking. All right, here's a case. This is a comprehensive case. This utilizes all the models that we've learned during the past week. Company XYZ is a growing company. It's a growing company. And its earnings per share for this year is $5. And let's draw a timeline. Time 0, 1, 2, and 3, 4, and it continues. And earnings per share, EPS, for time 0 is 5. Time 0 is 5. It's already occurred, $5 earnings per share available. And the company has been and will be paying 20% of earnings as dividends. So dividend per share is $1. Because payout ratio is 20%. The company's investment opportunities are expected to yield ROI of 20%. So ROI for the first period is 20%. And also, the second year ROI will continue to be 20%. So this is a growth company, and this has good investment opportunities. But from year 2 and on, the company's investment opportunities, they become, they disappear. They begin to subside. And assume that ROI for this period is 10%. And it will remain that way for the rest of its lifetime. So from year 2, after year 2, or year 3, from year 3, the company is essentially a normal company. A normal company or normal growth company or ordinary company, not different from any other average companies. But first 2 years, it's abnormal growth company because let's find growth companies, let's say G star, that's the growth rate for the first 2 years, is from the formula that I gave to you. Just grant me to use this formula, 1 minus theta, or B times ROI, is the growth rate. And during this period, it's 20% payout ratio. Therefore, 1 minus 20% times ROI of 20%. So 16% is the growth rate. Are you with me so far? It's simple rewriting of the same thing. Okay? The company will pay 20% DPS in year 1, and from year 2, the company's growth opportunities suddenly drops to 10%. Therefore, it will pay high dividends. So theta for this period is 20%. And year 1, it will also pay 20%. But from year 2, at the end of year 2, there is no more abnormal projects or abnormal investment opportunities. So it will pay 50% of earnings as dividends. Okay? So far, you're with me. And it will continue to pay 50%. Therefore, when the company becomes a normal one, 1 minus 50% payout ratio times ROI of 10%. So growth rate will be 5%. So far, you're with me. If you don't feel you're with me, just raise your question, raise your hand and ask me questions. I will allow you to speak in Korean if you don't understand it, and accept the request. Please speak in Korean. Okay. All right. Having computed growth rates for abnormal period as well as normal period, you can then produce EPSs. EPS for year 1, how much is it? EPS at year 1. Come on. What's growth rate all about? Okay. 정광이, how much is it? EPS 1 is equal to EPS 0 times 1 plus G star. Is it not? Is it not? So 5.80. Okay? That's 16% higher than previous EPS. And how about year 2? Same growth rate will pertain, right? How much? 6.73. How about year 3? From year 2 through year 3, growth rate suddenly drops to 5%. So EPS at time 3 is EPS at time 2 times 1 plus ordinary growth rate G. And that will be 7.06. And it will continue to grow at 5% from that point on. And I'm not going to write all of them down. Now, dividend per share, since price is the discounted value of future dividends, so we need to find dividends. So dividend time 1, 20% of 5.8, because 20% was the dividend payout ratio. How much is it? $16. So far, can you follow me? All right. Year two. Earnings per share has risen to 6.73, and now the company decides to pay 50% as dividends. So it's not just 16% higher than this, it will be 50% of this increased earnings, which is $3.37. And again, this one is 50% of that, so $3.53. And it will continue to grow at G. You can verify that. So far, okay? So far, okay? We are almost done. We are almost near the end. From investors' point of view, let's find price as of time 1. Price as of time 1. From this point on, look at this boxed numbers. Dividend at time 2, you know, right? Dividend at time 3. Dividend at time 3, is it, how large is it compared to dividend at time 2? For this boxed numbers, you can see that dividends are growing at the rate of, what's the growth rate for this? Say it louder. 5%? From here and on. I said it's a normal company because the company is growing at 10%. And when it is growing at 10%, the company pays 50% dividends and growth rate is 5%. So it's a 5% growth company. It's 5% growth will apply for the entire lifetime of the stock. Therefore, price at time 1 is dividend at time 2 divided by R minus G. And dividend time 2 is $3.37 divided by R, that's 10% minus G of 5%. And that's equal to, how much is it? 60, will someone calculate it for me? I think that's wrong. 67.4? Did you calculate it? 67.4. Okay, 67.4, right? Is that understood? Please pay attention to this, please. Okay. Right. Price at time 1 is 67.4, and price at time 0 thus is, at this point, price at time 0 is $1.16 of dividends plus. Second period, $1.16, and at this point, after this dividend is paid, the company's price is $67.40. divided by 1.10. And price is equal to 광희 calculated. Hmm? 62.332? 32. Hmm? Huh? 60? 33, okay. 62.33. So that's the price of this stock. Price of the stock is next period dividend plus next period price. That's the first equation that you were introduced when we discussed valuation of stock. Now here's the next catch. Okay, so far okay? It's hard but understandable, right? So you have to follow me up to this point so that I can go to the next step. Next step, ready to go to the next step? Suppose you're a director of this company. You are on the board of directors of this company. And you say, haha, instead of paying 50% as dividends, why don't we pay entire amount as dividends? In other words, pay theta being 100%. Since the company's return on investment is the same as company's required rate of return, why don't we simply pay everything out? Because the company does not have any advantage over stockholders. Stockholders can earn 10% and the company earns 10%. What good is it? The company is supposed to earn more than the stockholders. So as a company director, I say, well, why don't we pay everything as dividends? Let the shareholders take care of their own money themselves. So theta being 100%, then the growth rate will be 1 minus 1.0 times 0.10 equals 0%. Then your DPS will change. Instead of 337, it will be 673 and 706 and so on. So here's a new dividend box. Price at time 1 of this 100% dividend payout firm. What's the price at time 1? You should know. It's easy. No? Okay, Sora, how did you get it? EPS year 2? Okay, there's no growth. So 6.73 divided by R minus G. G is 0. Therefore, it's 67.30. Right? Then price at time 0 is this dividend plus this number. So 1.16 divided by 1.10 plus 67.30 divided by 1.10. This one must be wrong, incorrect, okay? Young, calculate it again. 3.37 divided by 0.05. 64? Okay. Well, anyway, if that's the case, that's fine. Calculate this. 1.16 plus 67.30 divided by 1.1. 62 point? Yeah? 2 to 4. They are not exactly the same. This one and this one, they are not exactly the same. This is because of the rounding here and there, but they are about the same. Okay. Now, the company, the same company, but two different dividend policies. Two different dividend policies. One is 50% payout. The other one is 100% payout. But whether it pays 50% or 100%, the company value is almost unchanged. Why? Why? I want you to come up with a simple answer to this question. Why? Ongun. Right, exactly. ROI is equal to 10%. The company's shareholders' opportunity cost of capital, shareholders' required rate of return is also 10%. So on the one hand, shareholders require 10%. They can earn 10%. And the company earns only 10%. So there is no growth for this. Okay. Growth is possible only when the company's return on investment is higher than the required rate of return. So this is a fundamental inequality that I want you to know from now and until the time you retire from your work. Okay? Invest when return on investment is greater than the required rate of return on investment. Invest when return on investment is greater than the cost of capital or opportunity cost of capital of the shareholders. It's common sense. It's common sense. You can ordinarily earn this rate of return. This is the rate of return that you, shareholders, investors, can ordinarily earn by your own effort. Okay? And if the company earns less than, what you can earn by yourself, the company should not invest. The company should pay that out as dividends so that you can invest as a shareholder. If the company does not pay out as dividends and invest in a project that yields less than this R, then the company is doing disservice to the shareholders. Shareholders could be better off by investing themselves rather than having the company invest. So companies' managers are given this task of investing in a project that yields more than shareholders require. Are you with me? This is a fundamental principle of finance. Fundamental principle of finance is you invest only when the return on investment is greater than the return that you require. Okay? That's critical. That's the most important part in finance. Financial decision making is fundamentally that one. Invest in a project that yields more than investors require. I repeat, invest in a project that yields more than what shareholders require. This is what shareholders require, and this is what the company can earn. Okay? Invest in a project that yields more than shareholders require. And the opposite of that is do not invest if your ROI is less than R. If you invest in a project that is that has less ROI than R, then you are doing disservice to your shareholders. And shareholders, if they have the power, they will remove you from management. That is the market pressure. The market has this ability to remove the manager, remove the CEO from his position or her position when his or her decision to invest yields return less than shareholders' required rate of return. Okay? Can you follow me? Okay? This is a critical point that we learn from this exercise. This is a comprehensive problem, and this tells you how dividend policy affects share price and how investment decisions ought to be made. Questions? Are you going to get this problem right if I write this on the exam? Okay. This will be on your test. Okay, this one, you've seen it, and you are doing your project by tonight. 12 o'clock midnight is the deadline of this project, segment number 5. Okay, features of common stock. A few things I'm going to read out of your lecture note. Common stockholders have voting rights. And the most important voting rights for them to make or to exercise is voting directors of a firm. They vote for directors. And directors make most of the operating decisions of the firm. Proxy voting is not all the shareholders, they come to the shareholders meeting and they actually physically vote. So what they do is they give proxy to someone else so that someone else is going to vote for the agendas of the shareholders meeting. There are different classes of stock, and that they are well described in your book, so I'm not going to talk about it. There are other rights. Common stockholders share proportionally in declared dividends. Common stockholders share proportionally in remaining assets during liquidation. And shareholders have this preemptive right. Suppose you are an owner, you are a shareholder who owns 10% of the entire shares. And suppose the company wants to issue additional shares. If the company completes additional share issuance, what is your proportion of the company's stock? If you own 10% of the stock and the company issues additional stock, and if you do not buy any more stock, then what is your proportion? Your proportion will be smaller than 10%. So your ownership proportion will be diminished because of the additional issuance of new shares. So preemptive right means that existing shareholders, they have the right to claim 10% of the newly issued shares. That's called preemptive right. Dividends are not a liability of the firm until a dividend has been declared by the board. If the board decides how much dividends to pay, then the company will have to pay dividends. But otherwise, even if the company pays no dividend or cut dividends, the company has no reason for the company to go bankrupt. Okay? Consequently, a firm cannot go bankrupt for not declaring dividends. Dividend payments are not considered a business expense, therefore they are not tax deductible. Dividends are paid out of earnings, not as expenses. The taxation of dividends received by individuals varies across countries. Different countries have different tax rates for dividends. Preferred stock. It's preferred. It's called preferred because it has preferred claim on the company's earnings. Preferred dividend must be paid before dividends can be paid to common stockholders. Dividends are not a liability of the firm, the same as common dividends. Preferred dividends can be deferred indefinitely. Even if the preferred stock does not pay dividends, the preferred shareholders cannot say that the company is in default. Most preferred dividends are cumulative. Any missed preferred dividends have to be paid before common dividends can be paid. So once you miss preferred stock dividend, then that much you will have to pay eventually before common stockholders are being paid of their dividends. Preferred stock generally do not carry voting rights. Exception is if preferred stock does not pay dividends, then preferred stock becomes like common stock and they have voting rights. We did it. Stock market. There are dealers and brokers. In the stock market, there are a few participants, but important participants are brokers and dealers. Brokers are the ones who match the buyer and the seller together and get the trade done. Okay, that's broker. I sold my house and I had a broker. That broker found a buyer for the house of mine. That's brokerage. Okay? On the other hand, there is a person or institution called a dealer. Dealer to a seller, dealer becomes a buyer on his own account. Dealer uses his money to buy stock or house from me and then hold it until he finds or she finds someone to buy from the dealer. So dealer is buying and selling on his or her own account using his or her own money. Okay? Dealer and broker are different. Dealer is making the trade, making the market between the buyer and seller on his own account. He uses his own money. Okay? Okay? Broker does not use his or her own money. Broker is simply connecting buyer and seller. Okay? New York Stock Exchange is the largest stock market in the world, and there are commission brokers, specialists, flow brokers, and flow traders. They are explained in your book, so I would like you to read your book instead of listening to my explanation. Operations and flow activity, they are also in your book. NASDAQ is a stock market for tech stocks. Technology stocks. NASDAQ is not a physical exchange. It's a computer-based quotation system, and there are multiple market makers. There are multiple dealers. There are so many dealers. An electronic communication network is used, and there are 3 levels. Read your book. Large portion of tech stocks are traded on NASDAQ. And in the US, company stock can be traded both in NASDAQ and New York Stock Exchange. In Korea, it's a different story. Kosdaq stocks will have to be traded on Kosdaq, and KSE stock will be traded on KSE. Next year or next semester, this semester is, I don't think I can find time, but next semester I'm going to bring my students to Korea Stock Exchange in Yeouido, and hopefully and possibly to Busan, where futures market, derivatives markets are located. And I'm going to show you what the stock exchange looks like. Back in the days when I was a student, we went to the stock market, and stock market has a large number of people. They have they shout and they trade with loud voices, very, very crowded and noisy. Nowadays, no crowd and no noise because it's electronic match. All the trades are matched by electronically. So it's huge computer. The only thing you see is huge computer. Okay? And you cannot even see that computer. So you can see only the building, and the explanation will be given by the officials of Korea Stock Exchange. But we'll make a trip to Korea Stock Exchange. That's Korea Stock Exchange. Singapore Exchange, this is a quote of Costco in, I think, Singapore stock market. I don't know when it is. It's May 29 of some year. I don't know which year it is. The last trade is the end of the day trade stock price. Trading time is 2:13 p.m. Maybe this is U.S. market. Change means the last price changed from yesterday's last price. Previous close is yesterday's closing price. Open price is the beginning of the day price. Bid price and ask price. Bid price is the market makers wants to buy at 73.27. Market maker wants to sell at 73.28. So the difference between the two is the market maker's profit. Days range for the whole day, it was 70.67 through 74.75, very volatile. 50-week range is 54 through 75, and volume is 6.8 million shares, which is much larger than average volume during the past 3 months of 4.9 million shares. Market cap is the market capitalization. The market value of entire stock outstanding is 31 billion US dollars. Price earnings ratio and EPS and dividend yield are all there. Okay, you are already familiar with it because you've done segment 1 and segment 4, and so you should be familiar with it. So I'm not going to talk any more about this. Okay, now I'll give you a brief preview of what we are going to do on Wednesday. Wednesday, we are done with fundamentals, foundation. We are going into capital investment decisions. And we will have, do sections 9.1 through 9.4 on Wednesday. So Wednesday class, it's basically chapter 9 of your book. Entire chapter 9 will be covered on Wednesday. And up to that point is your exam coverage. We'll talk about net present value of a project, payback of a project, discounted payback of a project, average rate of return of a project, and I missed it. 9.5 is internal rate of return of a project. Internal rate of return of a project. And I keep talking about project. What is a project? What is a project? That's the question I would like to raise, and I want you to think about while reading your book. Your book is not very friendly in explaining a project is. And project, by definition, is a set of economically dependent opportunities. They are opportunities, but set of opportunities. But opportunities are economically dependent. And some of these need explanations. Okay. An economic opportunity is an opportunity. The opportunity to earn money, opportunity to make money. Okay. Selling ice cream is an opportunity. Okay. Selling a textbook is an opportunity. Selling a clothing is an opportunity. And make a computer and sell and make money, that's an opportunity. So you have lots of opportunities. Suppose you have an empty lot and you are going to do a convenience store, 24-hour store. And next to it, you would like to open a gas store, a gas station. And you would like to open a garage, the repair shop. And you would like to open a motel. You would like to open a restaurant. Okay, these are all opportunities. But these opportunities, the revenues from these opportunities or profits from these opportunities are all economically related to each other. If my restaurant business is going well, my gas station business will go well. If my gas station business goes well, my repair shop will do well too. So the opportunities, they have economically related cash flows. These opportunities are called economically dependent opportunities, and we put all of them together and call them a project. Project is a set of economically dependent opportunities. Okay? If it is economically independent, you don't include in your project. Your project contains only the ones that are economically related. Okay? And project is the basic unit of capital investment decision. Okay? Project is the basic unit of capital investment decision. Okay, from Wednesday, I'll talk about Chapter 9. And hopefully I'll be able to finish Chapter 9 on Wednesday. And that's your midterm exam 2 coverage. And next week, I'll go into the rest of Chapter 9 and Chapter 10 and so on. So congratulations. You've completed the foundation of finance, the most difficult and tedious part. So you are ready to enjoy finance. Good month of May is coming up, and I would like you to enjoy financial management. Okay, that's all for today, and I'll see you on Wednesday.